Blockchain technology started as an experiment outside the traditional financial system. For years, it existed in a legal grey area, moving faster than the laws meant to control it. But today, that era is ending. Governments across the world are actively defining how blockchain and digital assets can be used in finance. Some countries are embracing it, others are restricting it, and a few are carefully redesigning their entire financial frameworks around it. In this video, we'll explore how blockchain is currently regulated in the United States, Europe, Qatar, and the United Arab Emirates, and then take a deep look into future legislation, including the Digital Asset Market Clarity Act, now being discussed in the United States. This is not speculation. This is the legal foundation of the next financial system. United States. Current regulatory landscape. The United States has one of the most complex regulatory environments for blockchain in the world. There is no single crypto law. Instead, regulation is divided among multiple agencies. The Securities and Exchange Commission, SEC, regulates digital assets classified as securities. The Commodity Futures Trading Commission, CFTC, oversees commodities like Bitcoin and Ethereum futures. Federal banking regulators supervise custody, payments, and stablecoins. This fragmented system has created years of confusion. Many blockchain companies do not know whether their tokens are securities, which regulator they must comply with, or how future enforcement actions may affect them. Stablecoins. A turning point. Recently, the US has made progress in one critical area: stablecoins. New legislation allows regulated banks and approved financial institutions to issue dollar-backed stablecoins, provided they hold full reserves, undergo audits, follow strict anti-money laundering rules. This signals something important. The US is no longer trying to stop blockchain. It is trying to control and integrate it. Still, large parts of the ecosystem remain unclear, especially decentralized finance, DeFi, crypto exchanges, tokenized assets. The Clarity Act, the future of US blockchain law. To solve this confusion, lawmakers introduced the Digital Asset Market Clarity Act, commonly called the Clarity Act. This bill aims to answer one fundamental question: who regulates digital assets, and how? Core goals of the Clarity Act. The Clarity Act proposes to clearly define digital commodities versus digital securities, assign primary oversight of digital commodities to the CFT, reduce overlapping authority between regulators, establish compliance rules for exchanges, brokers, and custodians, protect consumers without blocking innovation. One of the most important aspects of the Clarity Act is that it recognizes decentralization. Instead of assuming all tokens are securities, it introduces criteria to evaluate network control, governance, distribution, utility. If passed, the Clarity Act would give blockchain developers and investors something they've lacked for over a decade: legal certainty. Current status. As of now, the Clarity Act has not become law. Political disagreement, regulatory resistance, and broader financial concerns have delayed progress. But even in its current form, it shows a clear direction. The US is preparing for long-term blockchain integration. Europe's exciting MiCA and structured regulation. While the US debates, Europe has already acted. The Markets in Crypto Assets Regulation, known as MiCA, is the most comprehensive crypto framework in the world. It applies uniformly across all EU member states. What makes MiCA different? MiCA defines crypto asset categories, regulates exchanges and service providers, sets strict rules for stablecoins, requires transparency and consumer disclosures. Under MiCA, companies must obtain licenses, meet capital requirements, follow governance and risk management standards. This approach prioritizes financial stability and investor protection. The trade-off MiCA offers clarity, but it also increases compliance costs. Some startups find it restrictive, while institutional players welcome the structure. Europe's message is clear: blockchain is allowed, but only within a controlled system. Qatar, controlled blockchain adoption. Qatar has taken a very cautious position on cryptocurrencies. Retail crypto trading and speculative digital assets have largely been restricted due to concerns around market volatility, financial crime, consumer risk. However, this does not mean Qatar rejects blockchain technology. Through the Qatar Financial Center, regulators have introduced frameworks focused on tokenized financial instruments, enterprise blockchain solutions, regulated digital asset use cases. In simple terms, Qatar supports blockchain infrastructure, not speculative crypto markets. This reflects a broader trend in some regions, separating technology from open financial experimentation. United Arab Emirates, a global blockchain hub. The UAE has emerged as one of the most progressive blockchain jurisdictions in the world. Instead of banning or delaying, it built clear regulatory pathways. Key regulatory bodies. VARA Dubai regulates virtual assets within Dubai. ADGM Abu Dhabi offers a full crypto and digital asset framework. The UAE provides licensing for exchanges and custodians, compliance clarity support for Web3 and tokenization. This has attracted global exchanges, blockchain startups, institutional capital. The UAE's strategy is balance, strict regulation combined with openness to innovation. Global future. Where blockchain regulation is headed across the world, blockchain regulation is converging around three priorities: legal clarity, risk control, institutional participation. Future laws will focus less on banning technology and more on shaping its use. The Clarity Act in the US, MICA in Europe, and structured frameworks in the UAE all point toward the same future. Blockchain will not replace finance. It will become part of it. The era of unregulated blockchains ending. What comes next depends on legislation, political will, and regulatory design. Countries that provide clear, fair, and adaptive rules will lead the next financial revolution. Those that don't will follow.